So finding great value and paying very little price for that. Literally, the greatest investors pay literally nothing.
Right.
For what they buy.
Okay.
That's the trick of investing. And stock market is a funny place where you can buy 100 rupees thing for $5-10, and you can also sell at some euphoric time.
Sure.
$5-10 stuff for $100.
$100.
So and it's a very tricky situation.
Sure.
So you have to figure out. You have to be sure that you know the game. You are buying 100 rupees thing for 30, 40, 50, 60.
Right.
Definitely not paying more than $100.
Okay. So you're saying in order for an investor to be able to do this,
yes,
there should be certain principles that he should follow, which is what we are trying to show here.
See, any investing, whether you call it growth investing, value investing, penny stock investing, there are million names are there. Everybody is trying to find in different way a difference between price and value. Price is known to everybody. You have to figure out the value. I find it in particular way, QGLP we call it. But somebody uses some other method. Somebody uses the inside information also.
Sure.
Somebody just do the sidecar investing.
Right.
Okay, famous investors are buying this, so let me also pile on.
Right.
Which is a big way,
Right.
So there are various ways of getting to feel the value of the company. But world over, irrespective of style, the game is of finding the value vis-a-vis the price.
Okay. So viewers, remember, as we put out in one of our social media posts as well, you give a man a fish, you can feed him for a day. You teach a man how to fish, and you can enable him to not, or rather fill his stomach throughout his lifetime. And that's what we are attempting to do via this series. The first topic of the series is the power of focus, the importance of the power of focus in investing. Now, Raamdeo, why is focus so important?
Yeah. So as I said, understanding value is very important. Now, how do you understand value? There are 4,000 companies listed. Can you understand value of all the companies?
Obviously, you can't.
You cannot. So you have to arrive at. So human brain is brilliant, but it has its own limitation.
Yes.
And so you have to process few companies very well, better than the market. If you have to go and figure out value of say 100 companies, it's very tough. You will get somewhere,
sure,
but you'll not go deep enough. So you have to beat the market, because market is continuously pricing what market comes to know.
Sure.
So you have to be ahead of the market. So how do you go ahead of the market? Only by going deeper into that particular company.
Yes. Yes.
So and you can go deeper into very few companies. And strange thing or good thing about the stock market is that there are very few good companies, great companies. Time is friend of good companies and equally big enemy of bad companies. It's not like gold. Gold you buy anywhere.
Sure.
Over a period of time, if it doubles anywhere. It's not like that in the stock market.
Right.
If you buy a good company, like Infosys you bought in 93, it is 6,000 times.
Yes.
Okay.
6,000.
And if you bought say Kingfisher Airline or something like that, so that has become zero.
Yes.
During the same period. So it is very important to focus on few companies and few great companies and know very deeply about it. In fact, you must reach to a level where you must say, after the management, we are the first guys to be knowing enough about the company.
How do you know when you're choosing a company that this will be a great company? You don't.
Yeah, but there are financial parameters. That's where then the research starts.
Got it.
Then the understanding of what value pack means. What businesses are meant for.
Right.
What is the business meant for? It is meant to make money.
Sure.
It's a money-making machine. It's a cash flow machine. So somebody has given to that entrepreneur. See, it is a interaction. Businesses are interaction of capital given by, say, outsider,
yes,
and the entrepreneurship provided by the management.
Right.
When these two things come together to exploit a business idea, the magic happens if they are successful.
Got it.
If they are not successful, then the magic happens on the reverse side.
Okay.
The 100 becomes zero, or if magic happens, then 100 becomes to millions.
And if you are focused enough, you'll be able to identify this over the course of a...
Yeah. So it's like we'll try to give as many analogies. So you go and look at a cow. Okay. Cows for the milk, hens for the egg. So So, if a cow is giving a liter of milk, so price is at 10,000 bucks. But if after some time, for sure, after looking at the cow, this is very young, and if I do this, the cow could give 5 liters of milk. So there is no trading. The cow is standing there, you pay 10,000 bucks. Okay. After a year you come back, the cow is not sold, but the cow is actually giving 5 liters of milk. Does the price change?
It should.
Obviously it will be 5 times. So that is what happens in stocks. You have to figure out which company is going to make a lot more money. So there is always some evidence in the past. 10 years data, 5 years data, depending on the age of the company and what the company is doing. You look at that data, look at what is your understanding of the businesses, look at what is your understanding of the management competence. So it is interaction of the business. So, to start with, like we'll go to our framework, how we look at the value. That is, say, it starts with the fantastic business, long-term, very good business. So if businesses, there are 3 types of businesses. Okay. Good, great, gruesome. Right. There are 3 types of businesses.
Yes.
This Mr. Buffett wrote in 2007.
Okay.
In his letter, Berkshire Hathaway letter, 2007 annual letter, page 6 and 7. He talked about great, good, gruesome. My sense is, whatever he wrote in 60, 70 years, this is the best 2 pages he's ever written.
Okay.
And
2007.
2007 annual letter, page 6 and 7.
Page 6 and 7. Okay.
Yeah, you must download, take a printout, and read at least 50 times.
Wow. Okay.
I guarantee you, every time you read, you'll get something.
Okay.
Even now, I get something.
Awesome.
So it's an amazing piece of those 2 pages. And so the first thing is, figure out whether the company is good or bad. Don't look at the price. Don't go to the price. Price is last. People start with the price. That is the whole problem. First, assess the value. And the assessment of value starts from the quality of the business, underlying quality of the business. So there are good businesses, there are great businesses, and there are 90% of 9 out of 10 companies are bad businesses for long-term investing.
Got it.
So how do we clean up that first? So don't look. So what is a good business? We can go at length out there, but good business is a business which earns, say, 20-25% return on capital.
Yeah.
And if you want to double the profit, you have to put more money. But it keeps earning on a 10% risk-free, you're getting 20% return on capital. So all the banks and, so they are good businesses.
Sure.
Great businesses are where you make 25%, 30%, 40%, 50%, and eventually you don't need capital.
Sure.
Like Google and Microsoft, they don't need capital to make money. Or even Asian Paints, Nestle, Lever, Indigo. These companies, they don't need capital to make money. They just make money. So what more you want?
Sure.
But there are only 10%. Out of 4,000 companies, only 400-500 companies are this category. There are 3,500 companies which are substandard.
Which are gruesome in your
Gruesome.
Okay.
That's a very harsh word, but that's how it is. So
for the sake of simplicity.
I'm very clear. The first thing is, I have to say no, 9 out of 10 in any case, no.
Sure.
So I straight reached to 400 companies from 4,000. In 400, then we have to figure out quality of management.
Sure.
So for everything we have developed filter, and then you go one by one to figure out the value.